Welcome back to Financial Literacy for Lawyers, Bridging Law and Business. I'm Professor Seth C. Oranburg, and in this episode, we examine the balance sheet. It's a central document for assessing the true financial health of a business from a legal perspective. Rather than just a snapshot for accountants, this snapshot is a powerful tool for spotting insolvency risks, fraudulent conveyance risks, and other hazards that could upend deals, destroy client relationships, or even cause malpractice liability. As we learned in the previous episode with Han Solo's Enterprise, the balance sheet is a frozen photo capturing what a company owns, owes, and has left at a moment in time. It's always going to be recorded as of a particular date, which is often the fiscal year end for a business, which is also usually the 31st of December of a particular year, but not always. In any event, this snapshot can reveal vulnerabilities that bridge to business decisions and legal risk. So if you're still building confidence with numbers, remember, we're focusing on the business angles, not the accounting details. We're not doing the math, and we're dealing with this on a conceptual level. Because you don't need to be an expert, just familiar enough to ask the right questions. So don't worry if this feels new. We'll take it step by step. As a reminder, this podcast is for educational purposes only. For legal or financial advice, consult a qualified professional. The balance sheet is a snapshot of a company at a specific moment. It lists what the business owns, what are its assets like cash or property, what it owes, which are liabilities like debts or obligations such as loans or rent that it hasn't paid, and the residual, which is called equity. That's the owner's stake after we subtract the liabilities. Unlike the income statement that we'll cover next, which reveals a performance over time, the balance sheet lets you spot problems with solvency, risk of default, and overall business viability, like a detailed photograph of a company's standing that highlights cracks in the foundation. And is important because if you make certain deals when you're insolvent, you have fraudulent conveyance risk. So this moment in time is an important moment. Solvency here means the ability to pay long-term debts, while default risk is about missing payments that could trigger disputes. For lawyers bridging law and business, these aren't just double entry accounting. These are potential flashpoints. A bloated asset line might hide overvalued inventory that's hard to sell, while understated liabilities could mask pending lawsuits that are not yet quantified. Many think the balance sheet is too technical or irrelevant to law, but that's one of the myths we're going to bust because it's essential for spotting risks like insolvency or fraudulent transfers that affect business transactions. Ignoring the balance sheet would be like reviewing a contract without checking the attachments. You miss the full picture. Three core ratios often signal problems, and they're straightforward calculations that any lawyer can master with a basic calculator or spreadsheet. No math degree required. And if you don't remember how to do it, you can always ask ChatGPT. The first is the current ratio, which is the current assets divided by current liabilities. And current is just distinguished from long term. So these are assets that we're getting now versus payments that we owe now. The current ratio evaluates whether a company can meet its short-term obligations. So you could also think of it as the short-term ratio. So these are like bills due within a period of time, typically a year. A ratio below 1 is a red flag for liquidity trouble because the company might not have enough quick cash or sellable assets to immediately pay bills without borrowing or selling off core operations. A second is the debt to equity ratio, which is total liabilities divided by shareholder equity. Debt meaning liabilities, and equity meaning shareholders' equity. So again, not that complicated when you break through some jargon. A high value of debt to equity means there's a big reliance on debt financing as opposed to financing from the investor's own pockets. And that raises the risk profile, at least in certain cases, and it makes the company vulnerable to interest rate hikes or creditor demands that could force restructuring, again, raising issues involving insolvency. The third is called working capital, and that's current assets minus current liabilities. Negative working capital signals a lack of operational liquidity, meaning there may not be ability to pay when bills are due, like a client who can't fund ongoing operations without dipping into long-term assets, which tend to be less liquid. Like you can't necessarily sell your factory to pay your employees and end up with a business that still works. So, understanding these tools helps lawyers, lenders, and investors assess risk. It's not just for accountants. These are simple divisions that reveal big insights for business advising. And you can start by practicing on a familiar company's public filings. You can get them on Edgar, which is the SEC's database, and you'll see how quickly they become second nature. There's really only three key formulas, and they all sort of make sense. You're dealing with whether you can meet short term and long term obligations. The key is not about memorizing formulas, but understanding what they signal about stability. A key issue for business lawyers is monitoring for insolvency, and there are two main tests. Each test for insolvency has profound implications that can shift control and liabilities in transactions. The first is called balance sheet insolvency. And again, it's pretty simple once you get through the jargon. A balance sheet insolvency is when total liabilities, the amount owed, exceeds total assets, what you have. This is also called negative net worth because you actually owe less than you have. This status can trigger duties for directors to prioritize creditors over shareholders. It wipes out equity value, and it can spark litigation from creditors or regulators who claim mismanagement. Once this line is crossed, it can actually shift fiduciary duties, which are typically owed only to shareholders. And now we might owe duties to creditors. That opens the door to directors' personal liability for claims if directors continue favoring owners over these other stakeholders. The second is liquidity or working capital crisis. A liquidity crisis is where even if assets exceed liabilities on paper, in reality, there are insufficient current assets to pay debts as they become due. And that might show this cash flow insolvency. And we're going to have to get into other documents to find this because you won't find it on the balance sheet. This is often the real world trigger for bankruptcy filings, where companies appear solvent on the balance sheet, but can't actually operate day to day without constant cash infusions. Warning signs you should watch for include ongoing operational losses that deplete equity over quarters, negative working capital or current ratios that show long term imbalances, consistent loans to insiders or related parties that are unrecoverable and drain resources, and off balance sheet liabilities like guarantees or lease obligations that are buried in accounting footnotes, which aren't on the main balance sheet but commit future cash. Directors and their counsel must recognize these red flags early because courts will hold leaders accountable for failing to act once there is insolvency, because now they have duties to creditors and they have to honor those. Take a hypothetical tech company. Imagine that its board is being sued by creditors who claim that the directors ignored persistent negative equity on the balance sheet. Structuring a new financial deal under those conditions could expose the company to fraudulent conveyance claims, where creditors can argue that transfer of assets was designed to hinder the creditor's recovery. If the balance sheet shows liabilities exceed assets by $5 million at the time of the transfer, that's a huge amount of negative equity, and it's a classic red flag for insolvency, which can shift fiduciary duties to creditors and invite scrutiny by courts. But spotting it early could have allowed the board to restructure debt or seek fresh capital and avoid litigation altogether. This isn't abstract. It's the kind of scenario that plays out in real courtrooms. In the Toys R Us bankruptcy, creditors accused private equity owners of loading the company with unsustainable debt, and it evidenced this with a balance sheet bloated with liabilities from leveraged buyouts. The debt to equity ratio skyrocketed, leading to insolvency and massive job losses. Directors face lawsuits for breaching fiduciary duties to creditors, and while settlements resolved much of it, the case highlights how ignoring balance sheet imbalances can cascade into legal nightmares. So, how do you, as the lawyer, use this in your practice? Start by scanning for imbalances. High liabilities relative to assets might signal over leverage, and prompt advice on potential covenant breaches in loan agreements, so you should review those contracts, or even the risk of piercing the corporate veil, especially in closely held companies when insiders are taking dividends during these time periods. Look at the footnotes. They're like the fine print in a contract, and they can disclose contingencies like pending litigation or off balance sheet leases that could balloon liabilities under accounting standards. Challenges abound. Balance sheets can be manipulated. Assets can be overvalued. For example, goodwill could be presented as an asset, but it could be worthless in reality. And liabilities can be understated, like you could ignore environmental cleanup obligations. Enron's off balance sheet entities hid $25 billion in debt, and it fooled everyone until it didn't anymore. As a lawyer, flag these by cross checking with cash flows, and we'll cover how to do that later. And always ask, does this balance sheet align with business reality? To build your skills, you could try a low stakes exercise on your own time. Just pull a public company's 10K from the SEC Edgar database, like maybe Apple, or look for a smaller firm. Calculate the current ratio by dividing the current assets by the current liabilities and see what kind of numbers you find. A number about 1.5 would show stability, generally speaking, but you'll see a huge variety if you look at different types of industries. Then you can also calculate the debt to equity ratio by looking at total liabilities divided by total equity. Under 2 is often considered healthy, but again, industry matters. Finally, you can calculate working capital by subtracting the current liabilities from current assets. A positive working capital means there's some breathing room. You might jot down what risks reveal, like if low liquidity hits at a default in a downturn. And you can even go back in history and look at what the balance sheet said before a major crisis event occurred and see if it would have revealed something useful to you as a lawyer. Remember, you don't need to become a financial auditor, but if you can spot patterns that tie these balance sheet issues to legal risks, you become powerful in the boardroom. A declining current ratio could void a merger clause or trigger financial warranties, or high debt could trigger change of control provisions in contracts. In our next episode, we'll shift to the income statement, which is the movie, the performance over time, unlike the snapshot of the balance sheet. And we'll use these layered tools to uncover how revenue and expenses can mislead if not read critically. And until then, keep practicing those ratios. I'm Professor Seth C. Orenberg, and this has been Organized.